This is Blue Nile Tutorials. Here, we'll break down the auditing process step by step, including the critical topic of fraud. Fraud in auditing refers to intentional acts of deception, like misstating financial information or misusing company assets. Auditors focus on detecting material fraud that could affect financial statements, but the responsibility for preventing fraud lies with management. We'll cover how auditors assess fraud risk, identify red flags, and design procedures to respond to those risks. Let's get started. This video will cover how fraud relating to an audit client is managed by the audit team. ISO 240, the auditor's responsibilities relating to fraud, tells us that the auditors have a duty to identify and communicate any evidence found that fraud is present. Auditors have a responsibility to obtain reasonable assurance that the financial statements as a whole are free from material misstatements, whether they arise from fraud or error. The key difference between fraud and error is whether the misstatement was intentional or not. Fraud is criminal activity. There are two types the auditor may see. One is where there is a deliberate misstatement in the financial statements. This is known as fraudulent financial reporting. The other is the theft of company assets, or misappropriation of assets. The auditing standard does not state that it is the auditor's responsibility to prove whether fraud has happened. Their responsibility is to identify misstatements during the audit process and assess whether they are as a result of fraud or error. The responsibility for ensuring fraud is not present in the financial statements, and the company as a whole still remains with the directors. This is sometimes referred to as a primary responsibility towards fraud, with the auditor's responsibility being referred to as secondary. This is because the auditors are given some responsibility, not all, as they assess the risk of fraud based on the systems and transactions reviewed during the audit process. For the auditor to maintain their responsibility, they must maintain professional skepticism throughout the audit process. An inquiring mind can open up things that have been concealed within the organization. Assess any audit risks that could lead to fraud. Incentives to commit fraud should be considered, for example, bonus schemes based on profit margins. Generally assess the risk of material misstatements for the entity. Review how management react to and manage fraud. Talk to management to see if they are aware of any instances of fraud, and gather sufficient appropriate evidence from audit procedures designed to assess the risk of fraud. If the risk of fraud is high, the auditor must plan appropriate procedures to ensure that they are in the best position to detect fraud. They can ensure more experienced audit staff are available for the audit team. Increase sample sizes. Change audit procedures from what they would normally do, as being less predictable could catch out anyone trying to conceal fraud. Focus more on balances containing estimates from management, as this would be a popular area to manipulate figures. And also focus on the transactions posted around the year-end, as cutoff errors often are an intentional way of increasing or reducing balances. If fraud is found by the auditor, there are some simple steps to follow. Report it to those responsible for the audit team, for example, the audit manager and audit partner. They should then consider the evidence obtained and report this to the highest level of management at the client. If the auditor is suspicious that the management are involved, they should seek legal advice and consider whether they would report externally. Caution should be taken when reporting it externally, as the auditor has a duty to maintain confidentiality. If the evidence collected on fraud is incorrect, they would have had no reason to break confidentiality. If the fraud detected is material to the users of the financial information, then the auditor would need to modify the audit report to make the shareholders aware of the issue. In summary, fraud is an intentional act to deceive. The auditor may detect this as fraudulent financial reporting or misappropriation of assets. ISO 240 states that they have a responsibility to assess the risk of fraud and perform audit procedures to identify fraud. However, it is the director's responsibility to ensure fraud is not present in the organization and the financial statements. If fraud is found, the auditor must report this and consider whether it is material and whether the audit report should be modified. I hope you found this video useful. Thank you for watching.